Yeah, Karel, thank you very much. Dear Sergio, dear Michaela, honorable speakers, and of course, honorable guests. I'm glad to join you here today, though I experience that it's, sometimes challenging to travel from Brussels to Luxembourg because there's no high-speed train connections, and even the motorways are sometimes quite jammed. So, independent from travel distances, I'm confident the Luxembourgish Council Presidency, and we heard Pierre Gramegna earlier this day, will provide a strong impetus to progress and to conclude on major financial services and taxation dossiers, including dossiers of particular interest for the insurance sector, like the revision of the IMD, of course, and then the Solvency II third country equivalence. The European Parliament welcomes the ambitious outlook of the future Luxembourg presidency, as it is ready to foster legislation in a European regulatory landscape where legal certainty and coherence becomes more and more important, also with regard to the global perspective. And I'm particularly happy to see again Karel van Hulle here today. It is certainly positive to hear his well-known mantra, Solvency II is good for you once again. Ladies and gentlemen, the European institutions and the member states had for 1st of January 2016 when Solvency II must be applied. The European companies are very much engaged to complete the necessary preparations for the full application of Solvency II. The European supervisors already started some time ago with a preparatory phase and are tasked with completing certain pre-approval procedures in due time. The Commission is preparing the decisions on the third country equivalents. The Parliament and Council are eagerly waiting for them, as we are directly involved for the first time in equivalence of financial service legislation. Furthermore, the Commission is about to propose an alignment for the treatment of European long-term investment funds that was already decided some time ago by the European institutions. And last but not least, the European Parliament initiated an early revision of investments in long-term infrastructure under Solvency II, on which EIOPA started to work and is supposed to provide a first assessment to the Commission by the end of June. We are aware that there are still some steps ahead of us to ensure that the start of the application will be as smooth as possible. However, the framework for 2016 is set. The national implementation is ideally really already completed, and it is now time to see the system working. So far, the European approach. But a European approach cannot succeed on a standalone basis. The significance of the global debate is clear and visible to all of us here in the room. We all want our companies to become more competitive, to contribute to long-term stability and indeed also to growth. And at the same time, we all know that we can achieve more and more better when we work together than against. The envisioned covered agreement between the United States and the European Union is a positive development in this regard. We hope to see progress in this dialogue soon. And we are aware of the specificities of the US system, and we look favorably on the setup of this unprecedented procedure, which offers opportunities for the future and calls for special responsibility on both sides of the table. The European Parliament is more attentive to global regulatory activities than ever before. It is, from a Parliament's view, even more unsatisfactory that we are discussing on the basis of a rather vague information in a process that is led and dominated by the FSB and, sorry Felix, the IAIS. As politician, I'm increasingly concerned about the asymmetry in the availability of information and about the mismatch between the level of involvement and the democratic responsibility. Don't worry, there's a good personal relationship, so we can exchange all the information bilaterally, so that's not the real problem. Then, of course, the international process has to be more comprehensible, better traceable, and based on certain accountability. This is something the Parliament takes very seriously. We will address our concerns in an own initiative report where we tackle the Commission's accountability in international fora. Certainly, this has to include an ex post accountability by discussing and potentially launching a regular legislative process if existing European rules are essentially affected. Possibly, this has also to include an ex ante accountability by exchanging information and having a European dialogue during the negotiation process. The political level of the Economic and Monetary Affairs Committee in the European Parliament already addressed their concerns to Commissioner Lord Hill and to his predecessor, Michel Barnier. The information provided by the Commissioner so far is very much appreciated, but the process is still insufficient to tackle concerns that are repeatedly raised by the European institutions, by the European industry, by the European and national supervisors, and of course, by other stakeholders. And having mentioned this essential point on accountability and transparency, when we talk about the globalization of the insurance industry, we come directly to two questions. First, the one of a level playing field in the regulatory environment that affects those companies that are active at a global level. Second, the question of addressing systemic risks of large global institutions, which, if to be dealt with separately, are certainly best placed on the international level. These two questions may be answered in a simple way, namely that this is exactly what the FSB and the IAIS are currently working on. Nonetheless, it is not simple. All jurisdictions have their understanding and their way of regulating insurance companies and have not much appetite to deviate from it. And furthermore, it is the first time that there is a capital standard for insurance to be established on the international level. The banking sector has much more experience in the global standard setting, and this is something to which many concerns relate. Banking and insurance shall not be treated in the same way. I mentioned that on all my appearances here in front of you at the European Insurance Conference. But both have remarkably different roles in the financial business. Insurers were not at the heart of the financial crisis. They are funded by upfront premiums. They have a strong operating cash flow. They do not depend on wholesale funding, and their policies are generally long-term and thus stabilizing to the financial system. And those few insurance companies that experienced serious difficulties did so primarily in relation to their crazy banking business, but not so to their traditional insurance businesses. The insurance sector has its specific values and its specific long-term risk, and both need separate consideration. The baseline is that the difference between banking and insurance is and should be well acknowledged, politically and in the setup of the global regulatory requirements. The IIS shall certainly take the lead in the global discussions, and we Europeans shall make use of our means to strengthen the insurance way of thinking in the international bodies. A level playing field will probably be best achieved in ensuring comparability to the greatest extent possible. We should not refrain from aiming towards an ambitious solution. The IIS apparently intends to apply a factor-based approach in the calculation of the basic capital requirements. Solvency II accounts for a risk-sensitive approach which, according to a European understanding, is much more feasible for the insurance business model. A less sophisticated basic capital requirement might help to achieve acceptance and a workable compromise. Given the different methodologies for valuation worldwide, a factor-based requirement probably has an advantage in terms of implementation and comparability. However, as a European, and as far as European groups are concerned, I'm of the opinion that Solvency II rules on risk management and capital management shall prevail for matters of internal controlling and as a ground for the main supervisory activities. The Solvency II framework builds on risk-driven standard models and on the possibility to develop internal models. Those models require immense efforts by the companies and the supervisors who are in charge to approve and monitor them. The efforts shall not be left aside, even in a world with international capital standards. And then we have the question of how a global insurance framework can or shall contribute to mitigate systemic risks. I consider it useful to have a little stock-taking exercise first. The implementation of the Basel Code in banking establishes a mandatory capital buffer for systemic risk. The approaches towards systemic risk, the one in banking and the one in insurance, still have to be clearly distinguishable. The challenge refers, in my opinion, to the following questions. Firstly, what shall be the scope of establishing and triggering systemic risk measures considering the specificities of the insurance sector? Then secondly, how shall these measures look like and what is the methodology behind? And lastly, thirdly, who shall have the leading role to intervene and to tackle a systemic risk situation? In my view, ladies and gentlemen, there has to be a thorough assessment at the European level and on the global level where there's a necessity to intervene as regards systemic risk-related insurance regulation. I'm not asking here the if question, but I'm asking the where and the to which extent question. My provisional answer would be to focus on potential risk coming from non-core activities, from the interconnectedness with other financial sectors, and potentially from the interconnectedness in the insurance and reinsurance sector itself, which is to be further evaluated. And furthermore, and again, A risk-sensitive approach is necessary to identify and to cover the risks in the appropriate and proportionate way. The EU Solvency II directive already addresses systemic risk in insurance activities and covers requirements for resolution and recovery. And from 2016 onwards, a confidence level of 99.5% will be applied. This is almost 100%. A thorough resilience against external shocks, a firm risk management and strong liquidity provisions are certainly vital. This is notably true when we take due account on the current economic environment that challenges the insurance companies, in particular life insurance companies to a great extent. But nonetheless, do we want to implement a complementary system for the sake of 100% and thus no failure, and potentially end up with a result of no or less competitiveness? When we design regulatory measures, we have to keep their impact in mind. European companies in the insurance and reinsurance sector shall be able to operate in a regulatory environment that enables them to rely on their strengths, to remain reliable vis-à-vis their policyholders, and to be competitive also and in particular on the global level. And yes, I agree that there are needs to be much more care about globalization and the effects of the European legislation as regards competitiveness. As European Parliament, we have launched a report which will call for a thorough review of the financial services legislation in the past 5 years. It shall be a non-biased review, and the European institutions shall not shy away from a broad impact assessment within and across financial sectors, even it is difficult to quantify. The signals we received from the new British Commissioner, Lord Jonathan Hill, are truly more positive compared to his French predecessor, Michel Barnier. It is not our aim, to make it very clear, to have less regulation. But we should strive for the best possible regulation, and this possibly means more streamlined, more proportionate, and more globally competitive regulation in the end. I myself will be the rapporteur of this report, and I already started with my work. At the moment, the regulatory landscape is still a puzzle with many loose pieces. Now is the time to put those pieces together in order to strengthen practicability and efficiency of the overall picture. Then another prominent initiative on the European level is in this regard the Capital Markets Union. This initiative aims at diversifying the sources of funding for the real economy, in particular via fostering the accessibility of capital markets. I personally take the view that we make or must take a broader perspective here. Funding and investment is not only a question of the demand, but also of the supply side. And I consider it absolutely essential to build a European approach on the strengths of all financial sectors: banking, capital markets, and, of course, the insurance sector. It is in our interest to make use of capital that remains so far unused or unprofitable. A robust capital markets union can successfully contribute to foster risk mitigation. It can help to remove regulatory barriers, to complement existing financing models and initiate innovative new financing approaches. A comprehensive debate on this matter is, in my opinion, not only relevant for the European level, but also for the international level. And we shall not forget that Europe has a strong interconnectedness with its global neighbors. Europe rightly builds on its own strengths, but at the same time, it has to foster its attractiveness for international investors. Competitive international companies are our face in the global world. Ladies and gentlemen, to conclude, dear Karel, maybe you allow me to add something to your well-known mantra, Solvency II is good for you. I would say, yes, Solvency II is good for us. And strong global European insurance companies are also good for all of us. We have to keep this in mind, and we shall remain engaged with a strong European voice on the international level. Thank you very much.